There's no doubt Nvidia is the hottest stock on the market, and basically every AI company that exists today is relying on Nvidia in one form or another. So it's understandable that there's a lot of hype behind Nvidia's stock, but if you look at a lot of the attention that Nvidia is getting, the multiple it is trading for, what its fundamentals look like, I think there's also a lot of reasons to think that this is just the market's FOMO, or fear of missing out, driving a stock like this higher. We've seen this before, not only with Nvidia, but with other companies who are riding a wave that seems unstoppable in the moment, and in hindsight, it's not. So I want to dig into a few examples of why I think Nvidia stock is going to fall at least 50%, potentially even from here. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's start with a few of these broad investing themes that have gotten a lot of attention over the last decade or so. Let's start with the Metaverse. The Metaverse was supposed to be the next big thing. You might remember in 2020, 2021, that was really the topic. Who were the biggest names in the Metaverse? Well, Facebook changed its name to Meta Platforms. Massive shift in the way that they were looking at the company, leaning into virtual reality, augmented reality, and all the tools that they were building up upon that. What happened to the stock? At its low, Meta's stock had dropped 76% from its peak. This is the drawdowns in the stock price. So that's basically what is the peak stock price and how much does it fall from there. So 76%. A couple of other names that were very popular in the Metaverse theme. Matterport, down well over 90%. Now it's had a nice recovery here recently because they are being bought out by another company. The other one is Unity. Unity stock currently down 92% from its peak, recently hit a 52-week low. So if you invested in the Metaverse theme when it was getting a lot of headlines, it was a terrible investment. Another theme was crypto and the blockchain. Now, the data I'm looking at is from FinChat, so I can't pull in the drawdowns of cryptocurrencies themselves, but a lot of those fell 90% or more. You can see that Coinbase stock was down 90% at its low, made a really nice recovery for a number of different reasons, which I've covered here on this channel. But the drawdown from this peak hype cycle was really dramatic. What about 3D printing stocks? You might remember 2013, 2014, this was the hottest topic on the market. 3D printing was going to change everything about manufacturing. It didn't. The stocks that were associated with that, 3D Systems and Stratasys, are both down over 90%. You can go all the way back to the dot-com area, and this is an area where I think a lot of us are comparing the current AI bubble to what happened in 1999, 2000, and there's getting a lot of pushback. But the reality is the internet was a very big thing. That doesn't mean that investors did well. In 1999 and early 2000, some of the hottest stocks were Cisco, Microsoft, and Amazon, some of the most valuable companies in the world, just like Nvidia is today. What happened to their stocks? Well, by 2021, Amazon had dropped over 92%. Cisco dropped over 80% at its low. And Microsoft actually fared the best, but it was still down 60% for periods of time. The entire market didn't really recover. Amazon would be the first to hit its old peak, but that would take until 2009. Cisco has still not recovered to its pre-dot-com peak from a stock price perspective, and Microsoft took more than 15 years to get back to that level. So oftentimes hype doesn't last forever. And so when a stock is very hot, you're seeing a lot of headlines about it. That's oftentimes when you want to be the seller because that's the peak of the market from a FOMO perspective. But the second thing to think about is the maturity in the market and what we're actually doing with the thing that we're buying. So if you go back to the internet in the late 1990s, early 2000s, there was a ton of valuation in the internet because of all these companies that were valuing themselves based on eyeballs. But nobody was generating much revenue. Even a company like Amazon, who was growing like crazy, was not generating profit. So it took quite a while to actually build the business models that were going to work on the internet. Meta took a very long time to build out its advertising model. Google was very successful, but it didn't go public until the mid-2000s. It wasn't even founded until 1998. So oftentimes these new technology changes take a while to actually mature to the point where there's an ROI or a return on the investment that companies are making. Right now, the state of artificial intelligence is companies like Meta, Microsoft, Amazon, and even some of the startups that Nvidia is funding itself. They're just pouring money into artificial intelligence. So are the startups that are actually buying a lot of that compute time. But who's actually generating money? One of the great stats that has come out over the last month or two is that $50 billion has been invested in artificial intelligence to only generate $3 billion worth of revenue. Who is generating that incremental revenue? Who's generating a profit? Because at the end of the day, Nvidia only has demand for its chips if someone's actually making money on artificial intelligence. And it's not clear exactly who that is yet. So that's a great sign that this industry is just not very mature. And that's when you run into problems. That we did that with the internet in the late 1990s. You could say the same thing about 3D printing, about the blockchain, about the metaverse. There was this hype cycle and growth cycle, but there was no there quite yet. Doesn't mean we're not going to get there with artificial intelligence, but we're not there today. The third thing is competition. Today, Nvidia has around a 90% market share in the artificial intelligence GPU data center space. But that doesn't mean that everybody isn't coming for them. Intel, AMD, all of the customers that Nvidia has are trying to build their own chips. You have Alphabet, which has been building its own chips for decades, for years. Apple announced that they're going to be using their own chips for artificial intelligence inference. So everybody sees the success that Nvidia has. Everybody is forced to buy their products today. But 5-10 years from now, when the growth curve that investors are pricing in today needs to come to reality, is that actually going to come to fruition? That's where I think we have a lot of questions. Because competition is going to be very strong. We can just look back at Tesla. In 2021, it was thought that Tesla was going to generate 25% plus gross margins in the EV business because nobody could catch up to them. Guess what? Everybody caught up to them. Now everybody is introducing electric vehicles. Some of them are introducing electric vehicles for lower prices. There's competition from China. There's competition from US companies. There's competition from startups. Competition comes for everyone. And when it does, that's typically when you have a pullback in stocks because those valuation numbers become really important. So let's talk about valuation as well. That's the fourth thing that I think investors need to think about. Right now, Nvidia is really priced to perfection for a number of different reasons. You can see here that the company's price to sales multiple is over 40 and the price to earnings multiple is nearly 80. Now, you may think, well, that's actually justifiable because the 5-year growth rate for Nvidia is 50%. The 3-year growth rate is 60%. So this is a company that's growing like crazy. It deserves a very, very high multiple. But now we can get to the point where you need to ask yourself, what of that valuation is sustainable? And there's a few things to look at with Nvidia specifically. One is their growth rate. Is a 200% growth rate sustainable? It's absolutely not. And we've already seen signs that the growth rate is slowing. Doesn't mean that revenue is going to slow down and go negative, but the rate of growth is slowing. So ultimately, the question is going to be, what does the future growth rate look like? Right now, analysts are pricing in forward growth of 60% over the next 2 years. So maybe the company can hit that, but it's going to be much harder than it was over the last couple of years. The other thing is margins. Right now, gross margins, 78% for the most recent quarter, and the operating margin is 64.9%. That's an incredible margin, and that shows the pricing power that Nvidia has in the market. But as I talked about earlier, from both a demand side, which would be, have we overhyped the demand for AI tools, and from the supply side, which would be the competition piece, are we going to see margin compression in the future? We have seen margin tailwinds over the past few years, as you can see with that chart. But if we see margin compression over the next few years, now you have to start wondering, is Nvidia worth the multiple that we're paying for the stock? So valuation becomes a huge concern. And typically, companies that trade for these kinds of multiples are priced to perfection. So you have more risk to the downside than you have to the upside. The final reason to worry that Nvidia stock is going to have a huge pullback is because that's what Nvidia stock does. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. These are the drawdowns of Nvidia stock since the company's IPO. You can see that there are multiple periods of time when the stock has fallen 50% or more. Yes, after the dot-com bubble, but then again, it went on to hit peaks in 2021, fell 87% in 2022, actually a little bit more than that at its low, hit new peaks in 2007, only to fall over 80% in 2008. We've had pullbacks of 50% or more in 2009 and again in 2022. Nvidia has a history of these major pullbacks, in part because it is a company that invests in the hype thing. Nvidia had a huge boost in demand when Bitcoin became popular. And then Bitcoin miners got their own custom chips. So then it became popular when Ethereum became popular. And that was what the blockchain, the Ethereum blockchain was using to validate transactions. When Ethereum moved from proof of work to proof of stake, they didn't need all those GPUs anymore. So then we had a ton of GPUs in the market and Nvidia stock collapsed. AI eventually came along and filled that gap again, even more than we possibly could have thought. So the point is that if the market is overhyped in artificial intelligence, Nvidia is going to be the one to feel it the most. And we have a history of the company going through these boom and bust cycles. So be aware of the risks with a company like Nvidia with artificial intelligence today, because I keep hearing that things are different this time. And the reality is that things are rarely different. And I don't see a lot of fundamental return on investment from startups or from big companies who are investing in AI today. And until that return on investment happens and is sustainable, this is looking more like a bubble than it is like a sustainable investment. So just something to think about with Nvidia stock. But let me know your thoughts in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.